webinar. If you're watching the recorded version, it was held live on Wednesday, March the 14th at 12:30 in the afternoon. So this is a webinar to every lunchtime on a Wednesday with Aondo Markets, and it splits down into a couple of parts. We take a look at the major stuff. So we'll look at euro, pound, look at the indices, look at dollar yen today actually as well. Look at the indices, the S&P, the FTSE, the DAX, and also gold and oil. It feels like it's been a bit of a quieter week over the last week, even though we had the payrolls out, the non-farm payrolls out on Friday. But we'll take a look. I think there are still some interesting levels to look at. And what we also look at is a different sort of trading strategy or psychology or something like that every week. And this week we are going to take a look at the Stochastics, so a popular oscillator. We'll take a look at that. But I think that risk warning's been up long enough. So let's have a look at what's going on. I thought we'd take a look. I thought we'd start off with pound US dollar. We've seen a little bit of a boost for the pound in the last 5 minutes. We've had this US retail sales data come out. Let me just have a quick look on Twitter and see what the number actually was. It's clearly given the market a little bit of lift. So US retail sales, Feb 0.3%. They grew by 0.3%. The estimate was 0.2%. Okay, so slightly better than expected. Anyway, and of course we had those payrolls. The payrolls last week, U.S. unemployment numbers came out last Friday, and a big beat there. I think we saw 313,000 jobs added in the U.S. economy in February, and the expectation was for 200,000 jobs. So that was much better than expected. And I think the employment rate, the percentage of people unemployed, I think from memory it was the lowest since December 2000. I think so. So from a jobs point of view, all going well in the US. Right, let's get started. Let's start off with the pound. I think this week. I think it's interesting. It's interesting. I mean, I'm still bullish on the pound. You know, I think we've still got this. This is pound US dollar. We've got this trend now that's been chugging along for more than a year. If I pick up on that bit there, hang on, like that, you know, we've got clear uptrend in the pound. It's been quite corrective since January. It sort of sold off back down to once the 137 area, holding above that trend line, and now we're trading at 139.90. And I think what has been interesting is, I suppose this sort of thing you could say, we're just breaking out the last couple of days. You know, we've had, you know, I'm not a big fan of patterns, but something of maybe a triangle-y thing going on for the pound. You know, so we had this correction that's in place. The strength yesterday and the strength today looks to have broken that. So what, you know, my immediate target for the pound is still a run back to these old highs. So these old highs from 25th of Jan up around about 143.50, that sort of area. And any weakness looks like a buying opportunity. Just because it's broken that trend line, though, you know, don't think we're going to be suddenly off to the races. I think the opportunity here is if we saw the market, you know, maybe sell off a bit over the next couple of days after the strong week or strong 3 days it's had this week. If we see it sell off a bit, let's see how it performs down here. But that's, you know, it's a pretty positive sign that we've had over the last couple of days for pound US dollar. I think when it comes to bigger targets, more aggressive targets, you know, we have pushed into the immediate sort of post-Brexit sell-off zone. That's what we pushed into in January. 148, you know, I think 148, where it was bubbling along the highs just before the EU referendum vote. It doesn't seem, I think, too over ambitious a target for pound US dollar. This is a weekly chart. I flipped it to now, so that trend is still chugging along. Let's go on to the dailies again. Then we'll take a look. Let's take a look at the hourlies. Actually, let's do it now. I think maybe a bit wrong-footed last week by that break-in trend, but I think it's a useful illustration that just because, here we go, this is on the hourly chart, just because a trend line breaks doesn't necessarily mean that's it and bang, we're going right back to the beginning. You know, we did actually break through some big support levels on the way back down, but clearly the market has now surpassed the previous highs from March the 6th, and our newer sort of short-term trend line on the what's it, on the doesn't actually look like that. If I could draw it properly, it doesn't want to move. Okay, but it looks something maybe more like that. Not like that at all. I'm going to just put my fist through the screen in a minute. It looks something like that. I think on the hourly chart, it looks like that. So off those March 1st of March lows, it's chugging higher. I think the opportunity would be if we did see a bit of weakness come in and we sold back off below 139, maybe back to this sort of area. Could be a buying opportunity with stops below these lows from March the 9th and again on March the 12th. So let's see what happens. Maybe after the surge over the last couple of days, we'll see a bit of unwinding for the pound, but it doesn't really change the bigger picture that I do think the market's going to continue to move higher. So that's pound, US dollar. Euro dollar has been, I think it's been interesting. It's not been the most volatile of markets out there, but let's flip it over to the daily chart. I think what's interesting in euro dollar is if we see something happen that hasn't happened so far, and that's this big level breaking. On euro dollar, if we pick up on maybe our trend from about a year ago that looks something like that, that's still going, that trend. We just haven't made much progress over the last couple of months, and the really big level is 121.50. Okay, so we traded down here. Where's my little label gone? Traded down to here at about 121.50, rallies, comes back to 122, trades back down again, does have a look below the level the other week, 1st of March, so a couple of weeks ago, but then reverses really strongly. I think if we see 121.50 lost on the euro, it's quite a big break, and it could be a break of this trend line as well, depending on when it happens. At the moment, though, it's doing a good job. So at the moment, any weakness towards 122 for the euro still looks like a buying opportunity. It's not been the most exciting couple of weeks, but that level is clearly, I think, still underpinning the market. And I really am a big fan of these major levels. 121.65 was the low. It traded 121.55 there. So let's see what happens. What's also interesting, we don't normally look at this, but if we have a look at the really big picture for euro dollar, we've got to go back to what's happening with my screen? We've got to go back to 2008. Let me just flip it over to a weekly and see if it picks it up. Yes. So what is interesting, I think, for the longer term watchers of the euro against the dollar, this downtrend that started in 2008 is still going. So there we go. So we have, and it's almost a perfect downtrend. We have lower highs, lower lows. The market came back in May 2014, so it's 4 years ago now, to 140, sells off down to almost parity to the dollar, and then we've had this strong bounce back over the last 12, 14 months or so, and we're here again. So if you were long-term negative on the euro versus the dollar, this is the place to sell. So I think it's interesting. Clearly, it needs to break through these old highs to start showing signs of maybe shaking off that longer term downtrend. But it is interesting up here, and it maybe does go some way to explaining why we've seen somewhat cautious trading for euro dollar after the initial surge in January of this year. We've seen a fairly sideways market. So I would, just keep an eye on that bigger picture. And if that trend is going to play out, then it's really negative from here, because we're going to expect to see these old lows from a year ago, which I can't quite believe at the moment. But bearing in mind that I think plenty of people are quite negative on the US dollar still, which would point to a higher euro. When everyone tends to think the same way, that's when the market does the opposite. So let's see how this longer term thing plays out for euro dollar. But I think in the short term, the level to watch is 121.50, the old lows. Let's talk a bit about slow stochastics. So today's sort of education bit is talking about stochastics. I'm sure you're aware, if ever you've logged onto a trading platform, I find it quite depressing, to be honest, but there are 1,000,001 different indicators you can choose. And I think in the beginning, plenty of people waste time going through indicators and trying to find the perfect indicator. And there really isn't one. I think, price and trend, much more important than indicators. But that doesn't mean indicators can't add something. So what we're going to look at today is the slow stochastic. Look at all these different flavors of stochastics. We've got CCI, center of gravity, cyber cycle, stochastic fast, stochastic full, stochastic, so it goes on. Stochastic slow is the one we're going to look at. So if I just bring up stochastic slow, I've got it on the chart already. So let me just bring up. Basically, with stochastics, there are three things that go into them. There's a thing called percentage D. There's a thing called percentage. No, sorry. There's a thing called percentage K. There's a thing called percentage D, and there's a thing called percentage DN. So percentage K is pretty similar to the RSI, I think, in lots of ways. So percentage K, let's say we're looking at a 5-day stochastic. Percentage K, we'll look at the last 5 days. Then it calculates the range. It looks at the high and the low hit in the last 5 days, looks at where the market is trading today, and then expresses that as a percentage of the range. So for example, if the market has traded between a low of 30 and a high of 50 over the last 5 days, and the market's currently trading at 40, it's halfway through the range. Yeah? The range was 30 to 50, the market's at 40, it's halfway through the range. Percentage K is 50%. Okay, it's 50% through the range. So percentage K is the bit that does the actual hard work, but we don't see that in the stochastic, because what happens then, percentage K gets converted into these two lines. Okay, and the first of these lines is percentage D. Now, I hope you're all following this. On a 5-day stochastic, the normal settings are 5, 3, 3. So the first line we see, if I zoom in, so this is a 5-day stochastic down here. So the quicker line, this is percentage D. So what this is a 3-day moving average of percentage K, right? So it's a 3-day moving average of that raw calculation. Where is the price in terms of the range of the last 5 days? And then the second line we see, the second one here, this is known as percentage DN. And this also has a value of 3 in this example. And percentage DN is a 3-day moving average of the 3-day moving average. Okay, so percentage K is the bit that does the work. And then basically what we see are two smoothed out versions of that on the chart. Okay, hopefully that's clear. Again, you don't need to remember this stuff because clearly, the software works all that for you. But and then we have, as we have with other oscillators, we have overbought and oversold. So traditionally, anything above sort of 80%, the market, the RSI, the stochastic is saying, well, look, the market is overbought, it's gone too far. Anything below 30%. Sorry, anything above 70% is overbought. Anything below 30% is oversold. But what RSIs, what stochastics do, they try and give us a more definite signal, rather than just a vague overbought, oversold thing. They try and give us a definite signal. So for those of you who are familiar with moving averages, it's the same thing with stochastics. You get the crossover. Okay, so if we go back, this has worked particularly well. This was a good example to choose, completely unrehearsed. Euro dollar. There's our stochastic crossover up there. It was the 16th of Feb. That's the sell signal. Okay, and the market did sell off. Then we have, go to here, buy signal down here. Not too good, a little bit early. Then we have a buy signal when they cross over down here. That was better, much better. Coincided with a bullish engulfing candle. Then we had the sell signal up here, which was pretty good. And then we've had just, it looks like today, a buy signal off the stochastics. Okay, so that's how they're used, and we've talked about this idea of divergence in the past, where the market does one thing, but the oscillator does something else. I can't see a fantastic example there, so let's just flip it over to pound US dollar, see if we've got any better examples. That's not brilliant either. Oh, here, again, it's a bit messy, but it tends to be messy in the real world. So the idea of divergence is when you have a market that does, for example, this, slips to new lows, hits a low, trades a bit lower. But look what our stochastics doing. Stochastics make a low there, market moves lower, stochastics are already a little bit higher. So this thing is known as bullish divergence. So where the stochastics aren't following the market lower in this example, can be a suggestion that maybe the weakness is running out of steam. And the flip side at the top, it's not a brilliant example. Actually, up here, it's not bad, but it's okay. The market hits a high, stochastics are an extreme, so you're expecting the market to sell off. The market pushes higher still, but the stochastics don't go out to fresh highs. So this is bearish divergence. Okay, as you can see from these examples, it doesn't happen that often. So I think it is worth paying a little bit of attention to when it does happen. Okay, so that's our stochastics. We'll keep them on the charts for all the stuff we look at for the rest of today to see how they perform. So pound US dollar, stochastics are actually quite overbought now. So hopefully, if I was looking to trade that, be looking for maybe a bit of weakness and a better opportunity. Euro dollar, little bit boring, but any weakness back towards 122 still looks to be a buy. But let's bear in mind that bigger picture view, that 10-year downtrend almost, that's coming into play. Let's see. We'll look at euro sterling and dollar yen, then we will flip and look at some different markets. So here's euro sterling. I have to say I absolutely nailed this last week. I'm very happy about that. We've seen the euro rally, and we were at the top. We were at the top of the channel. We were getting pretty near the top, and since then, it's come off. The euro has sold off. Euro against the pound. I think it is pretty boring market at the moment, but we have got clear bands, clear extremes. It's been trapped because of all the ongoing Brexit rumblings. It's just been trapped now since September last year. But I think any weakness towards 90 looks like a sell. Any strength, towards 90 looks like a sell. Any weakness towards 87 looks like a buy. The stochastics down here have crossed over. Actually, so it's on the daily chart they've crossed over. Still looks a little bit weak if we look at the candlesticks. But really stuck in this sideways range. If I was a betting man, my money would be the euro sterling breaking out to the downside on relief that we don't end up with some horrendous Brexit negotiation later in the year. But let's see what happens. For the moment, it's still trapped in this range, and we need a breakout to give us the direction for the next major move. So pretty boring, but clearly tradable at the extremes. And then finally, dollar yen, and then we'll get a look into some other markets. I must admit, I haven't looked at this one for a while, but it's interesting clearly because it has been so weak. We've seen a lot of US dollar weakness. We've seen a lot of big levels broken, all of that sort of thing. So let's just go to a daily chart on dollar yen and see that it looks like maybe there could be a trade. If you're for the brave. So we broke these big levels on the way down in dollar yen, breaking below 108, then below 107. The market's traded nearly as low as 105. That trend is definitely still down, but maybe if you wanted to be a bit aggressive, it's a good risk reward trade. We had the break, we had the lows, the 16th of February lows, 105.54. The market on the 2nd of March traded as low as 105.20-ish, but we didn't get the follow through. We didn't have anywhere near the sort of follow through we'd be getting used to on this dollar yen move. So the aggressive trade, I think, could be to be a buyer, stop loss under the recent low, so about 100 or so points away from where we are now, but taking the view that maybe the weakness has been overdone. So betting on something of a dollar comeback against the yen. It does go completely against the trend, so I really shouldn't be saying this sort of thing because I'm a massive fan of trends. Obviously, that trend is still down. It has broken out, I suppose. Maybe you want to be a bit more patient, but I think it's interesting because we have seen when we've had pound against the dollar, euro dollar a little bit quiet over sort of the last couple of months or so. This is interesting because we have had such a big move in dollar yen. So maybe it's the contrarian play here where we've broken the support only intraday, but it has, we haven't had the follow through. So I think maybe dollar yen is an interesting one down here, looking for the elastic band to stretch back a bit up here. Maybe it's been stretched a bit too much to the downside, but my stop loss, if I was trading that, would be below that low. Let's see what happens. So let's go and have a look at stock markets. I must admit, this S&P rally has gone further than I thought it was going to go. So this is the broader US stock market, the S&P 500. So we had that massive volatility in Feb. So markets had hit fresh all-time highs, sold off really heavily. We've had the bounce back, and I suppose actually I was looking to sell it and I didn't, but I think it's interesting what's happened this week. We had the highs from the end of Feb at around about 27.90 on the S&P. This week it has had a few little looks through it, but it has been put under some pressure. So arguably, well, it depends what happens this afternoon, because of course the US market opens at 1:30 at the moment, doesn't it? Because their clocks have moved and ours haven't. Arguably the trade is, because we've pushed back up to those old Feb highs, if we have a retest of yesterday's highs and Monday's highs, is to go short, you know, because this level 2790-ish has held the market down. Let's see what happens. If we burst through those highs, we're sort of off to the races again, aren't we? You know, we are completely confounding me. You know, we can start thinking about maybe a run back to those old all-time highs for the end of Jan. But for me, I think that 2790 level could end up being something of a line in the sand. Let's see what happens the next few days. Stochastics up here. We had a sell signal back there on the stochastic. It was all right. Sell signal there, which is pretty good, and a sell signal. It looks like yesterday or the day before, Monday. Sell signal on Monday for this level up here. So let's see what happens up here. But I think if we do break out through this week's highs, let's say at 27.95, I do think amazingly we're going to go back and have a look at those old all-time highs. Let's see what happens with the US markets this afternoon. But clearly with this strength that we're seeing European markets dragged higher, a little bit higher today. FTSE, yeah, the FTSE's a right laggard, isn't it? But of course, the pound strength will be impacting the FTSE. Arguably, that's a buy. That the move we're seeing today for fans of candlestick patterns. If we end the day here, that is what's it called? Piercing pattern, where it moves through about 50% of the previous day's level. So again, the trade here would be the aggressive trade would be a stop loss under yesterday's low. The more conservative trade will be a stop loss under the lows from March the 5th. But it's interesting. I think that we've rallied, we've sold off for a couple of days, and we're seeing strength coming back today. Clearly, if these US markets get a bit of a lift, that is going to drag the FTSE higher. So I think that's an interesting one. Interesting little setup here with these support levels all fairly close to each other. Let's see how that pans out. What is that support level on the FTSE? Let's just plonk a line on there. 70.59, so just over 100 points away from where the market's trading now. Let's see if that level holds. And then the German 30, the DAX, similar to the FTSE, really, isn't it? I don't look as bullish these markets as the S&P 500, but there we go. So similar sort of stuff. Again, big level held. I think we picked up on this last week. So March the 5th, the market sold off, but held above those previous lows. So for stock markets, I still think we're going to see these US markets struggle a bit, but it's all about how do they act near these highs that we've seen earlier this week, just above 27.90 for the S&P. Let's see what happens. Now, gold and oil. I think oil is interesting at the moment, so we'll cover gold first because I don't think that's as interesting. Gold, there's a really big level on gold, and we've seen it tested again the 1st of March, and it's 1300. You know, it's easy to remember because it's a round number. There we go. So it's 1300. It did trade as low as 1302, I think. But on gold, any weakness back towards 1300 looks like a buying opportunity. You know, because you can see just these are daily candles that we're looking at. You can see just by the wicks left on the candles that it probes below, and it gets bought up during the day. You know, so I think it is interesting. Its volatility has dropped off quite a bit. You know, we're fairly sideways now for most of this year for gold, but clearly 1300 is providing something of a floor. You know, so I think if you were watching it and you're a bit nimble and it was trading below 1310, it does look like a buying opportunity at the price of gold. But 1300, I think, is still very much the big level. And let's take a look at oil. I do like oil because I think it's always volatile, isn't it? There's always sort of half decent swings in the price of oil. But let's just look at the big picture for oil. You know, and the story is, I think, is what's happened since last summer. You know, last summer, oil was $42 a barrel. It touched 66 earlier this year. So we've seen this 50% rally in the price of oil, and we've got really clear support. I was watching it yesterday and didn't do anything again. I've been very bad, really. But there was, again, an obvious level yesterday. But we've got 60, first of all. We'll look on the hourlies in a minute in a bit more depth. We've got $60, the lows from March the 1st. Goes back to it March the 2nd, and again, $60 holds. March the 8th, so a week ago, $60, and yesterday nearly $60. So 60 is clearly proven to be quite the level for the price of oil. Let's flip it over to an hourly chart, and you'll see this. Here we go. We'll see it in a bit more detail. So I think, was that the move? Was it yesterday evening I was looking at it? Yeah. And you can see just what a good job. Okay, it did again. It was set back here beginning of March, and it has probed through. But it's often, when you see a level probed, but you don't get the follow through, like on that dollar yen chart, that can be a signal just on its own that, okay, it's broken a support level. Classically, that would be a sell signal, but we're not getting the selling pressure. So maybe I want to be a buyer and you can have, in terms of stop loss, you can have a really tight stop, of course. So the risk reward is good, and then see what happens next for the market. But again, yesterday, big move yesterday, 2 o'clock yesterday, UK time, straight back into that zone, the low 60s, and the buyers have come back and lifted the price about $60 since yesterday. So I think for oil, the big trend is still up. 60 is doing a great job of stopping any weakness. Even if 60 breaks, I think 58 is another big level. Yeah, here we go. That's the really big one, I think, for oil at the moment from the middle of Feb. So if we did see 60 break and some pressure, watch to see how it reacts around about $58 a barrel. So there we go. That's it. I think there's plenty to keep an eye on. I think immediately, the immediate one for me is this afternoon, US markets. What happens with the S&P up at these old highs? We saw quite the sell-off yesterday. Let's just pick this up. That was yesterday's sort of moves from half one. Did see a rally right into the close. So the close, of course, at the moment is 8 o'clock UK time because of the clocks. And we've seen a bit of strength in the overnight market. But I really do think these old highs, well, actually they're up at 2,800 in the out of hours market, aren't they? The old highs up here. How do they perform? If the market gets back up there again, I would be tempted to be a seller into any weakness. So that's the immediate one. Pound US dollar, it's had a good run. Oh, it is coming off. Excellent. Hopefully it comes off, maybe back below 139, and there could be an opportunity there. And then maybe the more considered, patient, bigger trade is dollar yen at the moment, because it has been so weak. But we have seen, will you please change to a daily chart? We have seen no real follow through on this break. So the aggressive trade is to be a buyer with stop losses under the lows from here, beginning of March. So lots to watch. Nothing maybe to get excited about and start clicking on now, but I think lots to watch over the next couple of days to see how these markets react. Right, it is almost bang on 1 o'clock, so finish on time. We'll start wrapping things up there. As usual, of course, any questions, drop me an email. The best email for me is david@tradeafter.com. You can follow me on Twitter, and again, I need to get my backside in gear and do more tweets, but on Twitter, it's @JonesTheMarkets, and we will do it all again this time next week and see what's happened with those markets. Okay, so thanks very much for coming along, and I'll let you get back to your afternoon.